Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm joined today by Morningstar Investment Management's Dan Kemp to talk about the last 10 years of investing. Hello, Dan.
Hello, Emma.
So this year marks 10 years since the beginning of the global financial crisis.
Yep.
And it has been a bumpy ride. But I thought it would be useful for investors to see how far we've come over the last 10 years. And if you had been brave enough to hold on to your hat, which have been the assets that have performed best over the last decade?
Yeah, absolutely. And it's worth remembering that August 10 years ago was in some ways quite similar to where we are now. We'd come off the back of a very long run-up in asset prices. The economy seemed to be doing very well. There were certain parts of the market doing much better than others, but there also wasn't a lot of value. It was quite tightly constrained. And so, again, some similar characteristics. We don't seem to have some of the bubbles that were so obviously visible that time. Exactly. We hope we haven't got them. They're not underneath the surface. But there were some similarities. But it has made a huge difference what investors did at that time and what they've done subsequently.
So which then have been the standout asset classes?
Well, of the key ones I've looked at, US equities have been one of the best performers. But of course, it's made a huge difference whether you've been investing from the US or investing in the UK. One of the key trends we've seen over the last 10 years is a very sharp decline in the value of the pound. And so actually, you would have done so much better as a UK investor investing in US equities than as a dollar-based investor. And so we must always remember it's not just the assets you're investing in, it's the currency you're investing from. That's been one of the key messages of the last 10 years.
And indeed, to that point, there are a number of caveats when you're thinking about total return versus just looking at a line graph of what's performed over the last 10 years. Fees being one of them.
Absolutely. And so fees have had a huge effect on many investors. So if you think about what the UK stock market's done over that period, it's been a return of about 6.5% annually. Now, if you take off inflation, let's say that averages 2% over the long term, then you're down to about 4.5%. Well, if you take 1 or 2% off that, that's a huge proportion of the return. And so as ever, investors need to be thinking about the fees they're paying as little as possible and making sure they're paying for the right things, not just for expensive trackers, for example, but paying for advice maybe if that would be useful for them, or equally paying for high quality management.
Flipping that, though, because it's not all doom and gloom, that figure, looking at that line graph, doesn't include something which does uplift total return, and that, of course, is dividends.
Absolutely. And again, that's the other thing that makes an enormous difference to returns. If you just look at the price return of the UK stock market over the last 10 years, from this point 10 years ago, it looks pretty lackluster. If you add in reinvested dividends, makes a huge difference. And so there's two lessons there. The first is that you must think about making sure you're getting the dividends. That's not always the case with all investments. But equally, if you're an income investor, then the outcome for your capital may be very different if you're then using those dividends to spend. So dividends, as we know this from very long-term studies, make a huge difference and need to be one of the key considerations for any investor.
Of course, it is worth noting that this is a backward-looking conversation. And say you have been lucky enough to be a UK investor investing in US stock market over the last 10 years, and you have done incredibly well for that investment. This can't continue forever, can it?
No, absolutely right. And remember, we had huge drawdowns along the way. So whether you were invested in UK equities, US equities, emerging market equities, you'd have seen very significant falls and incredible returns from the bottom. And so when we're in a situation as we are now, when prices look high and not many assets appear to offer good value, then it's really important to remember that we may have similar declines in the future. The markets do go up and down. If you're a long-term investor, the last 10 years have taught us that you get a reasonable return, but you get a phenomenal return if you're able to invest when everyone else is scared. So again, look for good opportunities, look for unpopular assets rather than simply going after the most trendy investment.
Dan, thank you very much. This is Emma Wall for Morningstar. Thank you for watching.